on that. So we will continue from the concept where we have, left and ended our session 1 on India's 21. So we were talking about net investment in a foreign operation, right? So we had discussed in our session 1 on this that there could be three scenarios where there are transactions between the parent company and its foreign operation, right? So this is a parent company and this is a foreign operation, right? Now there could be three scenarios when a parent company and foreign operations enter into any transactions, for example, sales of goods, purchase of goods, loans, etc. So either it can be denominated in the functional currency of the reporting entity, right? So who is the reporting entity here is the parent, right? So parent can, do the transaction in its own currency, right? Similarly, another situation can be the transaction happens in the functional currency of the foreign operation, right? For example, if dollar is the functional currency of the parent and say GBP is the functional currency of foreign operation, right? Now, either the transaction, so for example, parent sells goods to foreign operation. So either this transaction can happen in dollar. If it happens in dollar, it will fall here. If it happens in GBP, it will fall here, right? And if it happens in any other currency other than dollar and the GBP, the third scenario is this, right? So this was we have been discussing in our last session. And what we have understood that if transaction is happening in the functional currency of the parent company, then in the financial statements of the parent company, as such, there wouldn't be any forex exchange gain or loss because parent's functional currency is dollar and parent is, billing, raising the invoice in dollar and it will receive the dollars only. Hence, there wouldn't be any exchange gain or loss in the standalone financial statements of the parent, right? But because foreign operation, parent functional currency is GBP, right? So for foreign operation entity, because it has purchased goods from the parent company in the dollars, so there would be a conversion required. Hence, there would be forex exchange gain or loss in the financial statements of the foreign operation, right? So scenario 1, when transaction is happening in the parent's functional currency, then forex exchange in gain or loss will be reflected in functional currency of financial statements of foreign operation, right? Foreign operations financial statements will have the forex exchange gain or loss, right? And this is SFS, standalone financial statement of the foreign operation. If the transaction of this sale of goods by the parent company to the foreign operation is happening in the functional currency of the foreign operation, right? Now, in this case, parent is having a functional currency of dollar, but not raising the invoice in dollar. They are selling the goods in foreign operations functional currency, that is GBP. Now, in this case, what will happen? Whose functional currency the transaction is happening in? This is foreign operations, right? Foreign operations functional currency. Then whose financial statements will have the forex gain or loss? Now, in this case, P's SFS will have the foreign exchange gain or loss, right? So reporting entities, that is the parent entity, separate financial statement will have the foreign exchange gain or loss, right? In this case, because foreign operations functional currency is the currency in which transaction is happening, right? If scenario 3, so this is the scenario 2 and this is the scenario 3. If the transaction between the parent and foreign operation is neither happening in the parent's functional currency nor happening in the foreign operations functional currency, in that case, both the financial statements, right? parent as well as functional foreign operations, standalone financial statements will have the foreign exchange gain or loss, right? Now, what the standard is saying, whoever is recording that forex exchange gain or loss have to record in P&L, right? So whether the forex exchange gain or loss is happening in the parent's financials, or it is happening in the foreign operations financials, or it is happening in both the financials, because transaction is happening in third currency. In all these cases, forex exchange gain or loss will hit P&L and not OCI, right? So OCI cannot be used here, right? Hope this concept is clear. Now, what we have talked about till now is standalone financial statements. Now, once the parent company consolidates its foreign operation and prepares the consolidated financial statements, right? In that case, where this forex exchange or gain or loss will go. So if the foreign exchange gain or loss is happening in the parent's standalone financial or foreign operations financial or both the financials, anyway, in the consolidated, it will be represented as a group's financials at one legal entity, right? So consolidated financial statement is prepared considering the entire group is single entity, right? Now for that single entity, what the standard is saying, in the consolidated financial statements, which includes foreign operation and the reporting entity, or accounted for using the equity method, such exchange differences shall be recognized in OCI. So in consolidated financial statement, it will be recorded in OCI. That is the standard requirement, right? So in standalone financial statements, whoever financial statement is having this gain or loss on account of foreign currency fluctuations because of these transactions will be recorded in P&L. But while preparing the consolidated financial statements, this will be recognized in OCI. Now, additionally, standard says on disposal of the net investment in foreign operations. So whenever parent disposes of net investment in the foreign operation, then all such accumulated gain or loss till the date of disposal will be reclassified from the equity to the P&L or as a reclassification adjustment, right? So as and when the parent company disposes of its interest in the foreign operation in that year, whatever accumulation is outstanding in this account, foreign currency reserve account, will be reclassified from equity to the P&L in the year of disposal, right? Now, thereafter, we have done this question as well in the last session. So I'm just, trying to build a connection, what we have discussed last and what we are going to do now. So just, doing a recap of this important concept because I thought it would be useful. So this was the question which we have covered in the last session. Functional currency of the parent is euro, while the functional currency of the subsidiary is USD, right? So parents is euro and subsidiary is dollar, right? P sells inventory to S. So parent is selling inventory to S and a transaction for the same was made for USD 300 during the year, right? At the year end, a balance of the same amount is outstanding as a receivable from S, right? Because parent company has sold the inventory to subsidiary company. So at the year end, parent's financial statement will be reflecting a debtor, that is a debtor balance from the subsidiary for the goods sold, right? It has been observed that such balance amount has been continuing as a receivable from S on year, and even though the payments in respect of these balances are expected to be received in the foreseeable future, but if we look at the year end, then we find these balances as outstanding every year and are not being settled in the past. So they are continuously outstanding. In addition to the trading balance, on account of this transaction between P and S, P has also lent an amount of USD 500 to the S that is not expected to be repaid in the foreseeable future. Should the exchange gain or difference, if any, be recognized in the P&L? Now, there are two things in this question. Number one, transaction is sale of goods by the parent company to the foreign operation for which debtor balance is continuously outstanding and it has not been settled by the subsidiary company to the parent company, right? And the loan which the parent company has given to the subsidiary company, for that loan, it is agreed with the subsidiary company that this loan is not expected to be repaid in the foreseeable future. So there is a no repayment clauses there, no repayment schedule has been agreed. So this is a kind of perpetual loan to the subsidiary company, right? Now we need to find out whether the first transaction will be a net investment hedge or not, whether the second transaction will be a net investment hedge or not. And if our answer is net investment hedge, then what would be the treatment? If answer is not a net investment hedge, what would be the treatment, right? So that although we have discussed this, I'm just repeating. Now, the exchange gain or loss will arise in the books of the P in respect of trading balance with S, and the same should be recognized in the P&L. Now, why in the books of parent? Because the transaction is happening in US dollar, right? And parent's functional currency is euro. And we have discussed if parent's functional currency is euro, and transaction is not happening in the parent's functional currency, but is happening in any other currency, then gain or loss will be in the books of the parent company, because a different currency is, taking place for the use for the transaction, right? Now, in this case, parent will, calculate the exchange gain or loss on this sale transaction, right? So hence, it will go to the PN. It will go to the PNL. That is the set rule that in the standalone financial statement, whenever there is a foreign exchange gain or loss, that will go to the PNL. Now, this being the balance for in the nature of the trade receivable for P, it would not be considered as net investment in the foreign operation because this is a trading balance, right? This is not the balance which is neither planned nor likely to occur. If you remember, we had discussed these two keywords earlier, right? If something is neither planned nor likely to occur or repaid in the foreseeable future, then only it will be called as net investment in the foreign operation. But if plan is there to be received, but actually it is not getting received or settled, then it does not fulfill this condition. Hence, that balance will not qualify for the net investment in the foreign operation, right? So if it is not planned, then only it will be net investment. Now for trading balance, this condition is not getting satisfied. Hence, this is a trading balance. So this is not to be treated as a net investment in the subsidiary or the foreign operation. But for the second transaction, that is the amount lent by P, should be regarded as net investment in yes or no? Yes. Why? Because the question's fact clearly says that this is not expected to be repaid in the foreseeable future. Not expected to be repaid in the foreseeable future, right? Now, what we will do in this case, the exchange gain or loss incurred by P on the loan of USD 500 should be recognized in P&L in the P's separate financial statements, right? Because in separate financial statement, P always exchange gain or loss is being recognized in the P&L. Now, while consolidation, it will be recognized in OCI that we have already discussed here on this slide, that whenever the entity prepares the consolidated financial, all such exchange gain or loss will be recognized in OCI. So, right. So this is the recap, whatever we had discussed in the previous session. Now, let's start for today's session. Now, there is a twist in the facts, which we have just done. Twist in the facts to the question. Modifying the above illustration, suppose that for tax reasons, the permanent funding, that is the loan amount of $500, which was given by the parent company to the subsidiary S for an operation, is made via another entity in the group T rather than from P directly. So earlier P was giving the loan directly, $500 loan, right? Now they are not giving directly. Okay. So what they are doing, parent is giving to the subsidiary T and subsidiary is giving that loan to subsidiary S of the parent, right? T is also the subsidiary of the P only. So parent is giving to another subsidiary and this subsidiary is giving to S, which is also a subsidiary of the parent. Where should the exchange difference, if any, will be recognized in this question? Now, as we know, exchange gain or loss will be recognized in the books of the company in whose books it arises, right? That we have discussed. Any exchange difference in respect of the loan is recognized in other comprehensive income in the consolidated financial statements because from the group's point of view, the funding relates to an investment in the foreign operation. This is the case irrespective of the currency in which the loan is denominated. So if the loan is denominated in T's functional currency, now let's get back to the diagram. Suppose in our example, euro was the currency, functional currency of the parent, right? And USD was the functional currency of subsidiary earlier. Now, but because parent is giving to T and T is giving to S, suppose T's functional currency is say Japanese yen, for example, right? Now, question is in whose financial statements foreign exchange gain or loss will be there? Now, what is the answer? If the loan is denominated in T's functional currency, and this is different from that of S, then exchange difference is still should be recognized in other comprehensive income in the consolidated financial statements. So if T's functional currency is same to that of P or is different to that of P, it hardly matters because anyway, while preparing the consolidated financial statements, ultimately the loan is, being passed on to subsidiary S whose functional currency is USD, right? So if P gives loan directly in USD to the subsidiary or P gives this loan via some other subsidiary and other subsidiary gives it in USD, it will ultimately lead to the same impact, that is exchange difference will be there and it will be recognized in the consolidated financial statements. So irrespective of the fact whether there are any third party or fourth parties being involved in the arrangement or not, we just need to see if the currencies, functional currency of the parent and the ultimate subsidiary is same or not. If it is not same, there would be certainly foreign exchange gain or loss, right? I hope the concept is clear. It was easy thing. Now, as we know, you must have, studied India's 110 consolidated financial statements. And under that, you must have, understood that whenever there are any intra-group transactions, happening between the parent, subsidiary parent, right? So while preparing the consolidated financial statements, those transactions or balances, gets eliminated, right? That we have already been doing, elimination of the intra-group balances. Now, what additionally this standard wants to talk about on this topic, although this topic is not the topic of this standard, but still there is one matter which is to be discussed here. Although intra-group balances are eliminated on consolidation, right, under Ind AS 110, right, any related foreign exchange gain or loss will not be eliminated, right? So if parent company is selling goods to the subsidiary company, right? So while preparing the consolidated financial statements, debtor from the subsidiary and creditor in the parent from the subsidiary. So these debtor and credit balances will be eliminated or knocked off, right? Getting my point? But because these transactions have happened in different currencies, so there is a official or formal obligation on the part of payer or settler to purchase the equivalent number of currencies and remit it to the other entity. So because of that obligation, there is a real exposure. Mark my words, real exposure to the forex risk, and that risk cannot be eliminated by preparing the consolidated financial statement. So consolidated financial statements only results into knocking off the balances, but in order to settle those obligations or the real exposure which we have taken because of entering into the transactions in different currencies, so we have the official obligation or real exposure to settle those transactions into those currencies. Hence we are exposed to forex risk. That exposure to forex risk cannot be considered as a part of elimination entries or elimination adjustments while preparing the consolidated financial statements. So what the standard is saying, these exchange gains or losses on forex will not be eliminated. This is because the group has real exposure, real exposure to the foreign currency, since one of the entities will need to obtain or sell foreign currency in order to settle the obligation or realize the proceeds received, right? So entity is obliged to settle or receive those balances or payments in the foreign currency. Hence they are exposed to the foreign currency risk. That's why this forex exchange gain or loss which has been recorded in the separate financial statements will not be eliminated. So what is the thumb rule? So while preparing the consolidations, so debtor balance and creditor balance, right, this will be eliminated, yes or no? Yes, right, under 110. But under 21, forex gain or loss on above balances or transactions will not be eliminated, right? Because we have the real exposure, right? So this is the rule. Accordingly, while preparing the consolidated financial statements of the reporting entity, the exchange difference arising on such intra-group transactions is recognized in the statement of profit and loss account unless it arises from a monetary item that forms part of the reporting entity's net investment in the foreign operation. So while preparing the consolidated financial statement, any such exchange gain or loss which has been recognized in the separate financial statements either of the parent company or of the foreign operation or of both the companies, right, will not be eliminated while preparing the consolidated financial statements unless it arises from a monetary item that forms part of the reporting entity's net investment in the foreign operation, in which case it is taken to the OCI. So ideally it should be reflected in P&L, but if it is pertaining to the transaction because of net investment in the foreign operation, then it will be reflected in other comprehensive income, OCI, and accumulated in the separate component of equity and reclassified to P&L only on disposal, that we have already discussed in this chart, right? On disposal, it will be reclassified to P&L, right? Correct? Okay. Let's do a quick question to crystallize the concept we just understood here. ICAI Limited is the parent company P, has the functional currency GBP. while the cloud corporation is the subsidiary, has the functional currency USD. So subsidiary USD, right? During the year, Sky Limited sold goods having value of GBP 1000 to cloud when the exchange rate was GBP 1 to 1.2. So sells goods for how much? GBP 1000. Sorry, 1000. Okay. Now, if the transaction is happening in GBP and GBP is the functional currency of the parent, so in parent's SFS, will there be any exchange gain or loss? No, because functional currency is the same as to what in which the transaction is happening. Now, the next question, in the subsidiary company, SFS, standalone financial statement, will there be any gain or loss? Yes, because its functional currency is USD and transaction is happening in GBP. Because transaction is in GBP and its functional currency USD, so there will be forex gain or loss, right? Yes or no? Yes. In SFS, standalone financial statements. Now, at the year end, the amount is still pending to be paid by the subsidiary company to the parent company, and the exchange rate on the year end date is how much? GBP 1 to USD 1.3. You are required to determine how should the exchange difference be accounted for in the consolidated financial statements. So first is parent company is selling goods to the subsidiary company. Parent company's functional currency is GBP. Subsidiaries company functional currency is USD, and the transaction is happening in GBP. Because GBP is the functional currency of parent in which the transaction is happening, so parents companies standalone financial statements will not have any foreign exchange gain or loss because the currency is same. But in the books of foreign operation, that is the subsidiary company or cloud corp, because functional currency is different and transaction is happening in different currency, so there will be forex exchange gain or loss to be recorded in the books of the subsidiary company. Now, where this exchange gain or loss, whatever it would be, will be recorded, it will be recorded in P&L. Yes or no? Yes, because we have a thumb rule that in standalone financial statements, it will be recorded in the P&L only, irrespective of the fact it is being happening in the parent's company financials or the foreign operations financials or the both companies financials, right? Now, how the same needs to be accounted for in CFS consolidated? That's the question is. Let's see. At the year end, Cloud Corp, that is subsidiary company, should revalue its accounts payable because it has purchased goods. So it will be, discharging the obligation. So it must be having a creditor balance, accounts payable from USD 1200 to USD 1300. How come? So GBP 1000, was the sale value by the parent to the subsidiary. This has been converted to USD. So 100,000 into my 1.2. How much? 1200. So 1200 is the amount of the transaction in the USD, and this balance, if reinstated, will be 1300, right? On the year-end financial date. Now, this is what the calculation is presented. So USD 1300, right? While the books of parent Sky Limited receivable balance from the corp would be GBP because they will be recording the transaction in GBP only. Now, during the consolidation by Sky Limited, who is the parent company, right? Parent company is now preparing the consolidated financial statements. The assets and liabilities of the subsidiary company, Cloud Corp, will be translated to the GBP at the closing rate, that is GBP 1000, will get eliminated against the receivable in the books of the Sky Limited. So, okay, let's do quick presentation here of the P's financials, parent. So, in parent's financial statement balance sheet, right? Transaction is appearing as debtor balance of how much? GBP 1000, right? Because transaction is happening in GBP only. So it will continue to record GBP. Now in subsidiaries balance sheet, initially the debtor balance was how much? Or creditor balance was how much? USD 1200, right? Now it will be reinstated to how much? USD 1300. So earlier the liability was 1200 on the date of transaction. At the date of the preparation of the balance sheet, the liability becomes 1300. So $100 is the loss on account of exchange fluctuation. Yes or no? Yes. Now, this USD 100 exchange loss recorded in the subsidiary, that is a Cloud Corp statement P&L, has no equivalent gain in the ICAI's parents' financial statements, because parents' financial statements will not have any forex exchange gain or loss. Therefore, USD 100 loss will remain in the consolidated financial statement P&L, right? Because this is the real exposure by the subsidiary company to purchase the US dollars, purchase the GBP and discharge the obligation, because it is a its functional currency is US dollar. So by purchasing GBP by paying USD, they will be incurring 100 loss if they discharge this obligation on the closing date, right? So this 100 loss will remain in the P&L of the subsidiary, and while preparing the consolidated, this 100 loss will continue to be reflected in the P&L of the consolidated financial statement, right? The reason for this that is intra-group balance represents a commitment to translate USD into the GBP on the subsidiary company side, and this is similar to the holding a foreign currency asset in the parent company. The subsidiary must go out and buy the GBP to settle the obligation to the parent. So the group as a whole has a real exposure to the foreign currency risk, right? So by doing this question, we must have understood that foreign exchange gain or loss will not be eliminated while preparing the consolidated financial statements. So what's the learning from this concept and this question? Forex gain or loss will never be eliminated while preparing consolidated financial statements, right? So this is the rule which we have understood. Now, the point which must be coming in your mind, that earlier we discussed that such gain or loss, will be recognized in OCI while preparing consolidated. But in question, we are saying that it is being recognized in P&L here. Why not OCI, sir? In the chart, we have discussed that while preparing the consolidated financial statement, exchange gain or loss will go to the OCI. But now, while doing this question, we are saying that this exchange gain or loss while preparing the consolidated financial statement will be reflected in the P&L. I mentioned that this will be recognized in OCI only if this is pertaining to net investment, right? And this transaction is having a trading balance because this is a sale and purchase of inventory, right? So this is not a net investment transaction. Had this transaction be in the form of loan given for a perpetual period with no repayment, then forex exchange gain or loss on that net investment hedge transaction would, be recognized in the OCI while preparing the consolidated financial statement. But for trading balances or trading, transactions which are not investment hedge transactions, it will go to the P&L. So another rule, if the transaction, okay, let me summarize the whole concept once for you. Let me find some white space. Okay, I will be using this white space. Now, there are two types of balances. Number one, net investment. Number two, trading, right? Which is not in net investment basically, right? For the sake of simplicity, we are saying trading, right? But not a net investment basically. Now, in standalone financial statement, exchange gain or loss, P&L. In standalone financial statement, exchange gain or loss, P&L. In consolidated financial statement, exchange gain or loss, OCI. In consolidated financial statement, exchange gain or loss, P&L. Clear through this chart? So if transaction is net investment hedge transaction, then in standalone financial statement, P&L, but in consolidated financial statement, OCI. If the transaction is in the nature of trading balances, then standalone as well as consolidated financial statement, it will be P&L. Clear point now? No doubts? Let's do one more question. The functional currency of big limited parent is GBP and small corp subsidiary functional currency is USD. So parent companies is GBP and subsidiary company is USD. Big limited reporting date is 31st December. On June 30, 2018, Big Limited lends GBP 2000 to small. So Big Limited is giving a loan of 2000. How much? GBP. Now GBP is the functional currency of which company? Parent company, right? So functional currency is of the parent company in which the transaction is taking place. On receipt of the amount in GBP, a small corp converts the cash to US dollar. Now, after receiving this loan, subsidiary company converted this loan into the USD because ultimately they need USD only because their functional currency is USD. Now, exchange rate on 30th June, that is the date of transaction, and year end, that is the 31st December, is this much. You are required to show the accounting treatment of the above transactions in the books of Big Limited and in the books of Small Limited. Right? Now we need to tell what would be the accounting treatment for this transaction in both the books of accounts. That is both the standalone financial statements of the parent as well as the subsidiary. Facts are clear. Let's see. First, we will discuss books of small corp, that is the subsidiary company, right? Now, on 30th June, what is happening? They are receiving the cash and credit to the holding company intra-group payable. So credit to P, parent company, 2,500, 2,500. How this 2,500 has arrived? Because we are getting a loan of GBP 2,000, right? Into May. 1.25 is the rate on the date. So how much? 2,500. On 31st December 2018, we need to record the exchange gain or loss. Now what is happening? If the loss is happening, we will debit the P&L. If the gain is happening, we will credit the P&L. Now the revised, liability of this loan will be 2,000 into my 1.5. How much? 3,000. Right? Now, I had received $2,500, but I will be, having a liability reinstated at $3,000. So $5,000, $500 is the loss I will be incurring because of this reinstatement. So I will debit exchange gain or loss account in the P&L debit by 500 to intra-group payable liabilities reinstated for towards P 500 to recognize the exchange gain or loss on the intra-group loan. In small corps, the second entry is to remeasure the liability as at December 31st, 2018, and the loss on the remeasurement is recorded. So this is the accounting treatment in the standalone financial statements of the subsidiary company. I hope this is super simple. Now, in the books of B, parent company, P, Big Limited, intra-group receivable account debit 2000 GBP to cash 2000 GBP. Now, because functional currency of the Big Limited is what? GBP. And loan is given in which currency? GBP. And it will be coming back in GBP. So, since there is no different currency involved, hence there wouldn't be any exchange gain or loss in the books of parent company. Hence, only one entry, that is subsidiary company loan account debit to bank or cash 2000 GBP, 2000 GBP, right? In the financial statements of the group at December 31, 2018, USD 3000 will convert to GBP 2000, right? And the receivable and payable will be eliminated. However, an exchange loss equivalent to USD 500 for the year ended 31st December 2018 will be reported in the consolidated statement P&L, right? So exchange gain or loss will be reflected in consolidated financial statement because there is a real risk to transfer the GBP. Correct? Okay. Let's do one more question. M Limited is engaged in the business of the manufacturing of the bottles for the pharmaceutical companies and non-pharmaceutical companies. It has wholly owned subsidiary G Limited, which is engaged in the business of pharmaceutical. G Limited purchases the pharmaceutical bottles from its parent company, right? So what is happening? M Limited is a company who is in the business of manufacturing of bottles, right? And it has a subsidiary G Limited who purchases the pharmaceutical bottles from its so M Limited sells bottles to G Limited, right? The demand of the G Limited is very high, and hence to cater its shortfall, G Limited also purchases bottles from other companies. Purchases are made at the competitive prices. So G Limited is purchasing from M Limited parent company as well as some other suppliers too, right? M Limited sold pharmaceutical bottles to G Limited for euros 12 lakhs on 1st of February 2001. The cost of these bottles was 830 lakhs in the books of M Limited. So this is the cost, right? At the time of sale. At the year end, 31st March 2001, all these bottles were lying as a closing stock and payable with G Limited, right? So these bottles were unsold and there is a creditor balance in the books of G Limited subsidiary because subsidiary has purchased those bottles from the M Limited for euros 12 lakhs, and the cost of that those bottles is 830 lakhs in the books of M Limited in M's functional currency, right? Euro is the functional currency of G Limited, while Indian rupees is the functional currency of M Limited. So M Limited's functional currency is INR and G's functional currency is Euro, right? 12 lakh euros is the transaction value, and this is the closing stock appearing here and the creditor balance appearing here, right? And in INR, cost is 830 lakhs for this these bottles, and corresponding debtor balance will be appearing here in the books of M Limited, right? Exchange rates as on the date of transaction and at the year end are 83 rupees per euro and 85 rupees per euro. Provide accounting treatment for the above in the books of M and G Limited also show its impact on the consolidated financial statement. Support your answer by the journal entries wherever necessary in the books of M Limited. So we need to provide the accounting treatment for the above transaction in standalone financial statements of M Limited and G Limited and in consolidated financial statements. And we need to, support our answer by giving the journal entries as and when necessary. So these are the facts of the question. Now let's see how this transaction will be accounted for. Now, first, accounting treatment in the books of M Limited, that is the parent company. Parent company, functional currency is INR, right? Now, M Limited will recognize sales of 996 lakhs. How? 12 lakhs euros into 83 rupees on the date of the sale. Here it is. Right? Profit on sale of inventory is 996 lakhs minus 830 lakhs, 166 lakhs. So 830 lakhs cost is given here for these bottles, which the parent company has sold to the subsidiary company. Now, 166 lakhs is the profit, made by the parent company on this sale transaction to the subsidiary company. On the balance sheet date, receivable from G Limited will be translated at the closing rate of euro 85. Therefore, unrealized foreign exchange gain will be recorded in the standalone profit and loss of rupees 24 lakhs. How come? 12 lakhs euros into 85 minus 83, that is 2 rupees. So 2 rupees into 12 lakhs, so is equal to 24 lakhs. So 24 lakhs is the exchange gain or loss that the parent company will be recording. Why parent company will be recording? Because parent's company's functional currency is INR and it has invoiced or sold the goods in euros. So parent company is here getting impacted by the foreign exchange gain or loss, right? Now, what would be the journal entries? First journal entry, subsidiary company account debit to sales. How much? 996 lakhs, 996 lakhs. Then foreign exchange gain or loss will be recorded. So subsidiary company account debit, that is debtor balance, will be reinstated to foreign exchange gain income account in the P&L. 24 lakhs, 24 lakhs. Because this is the standalone financial statements, right? So P&L will be credited by the exchange gain in the books of the parent company. Now, in the books of subsidiary company, now subsidiary company has the functional currency euro, right? And the transaction is happening in euros, right? So functional subsidiary company will not have any forex risk or gain or loss. So forex gain or loss will not be there, right? So the only one journal entry, purchase account debit to parent company account M Limited, the creditor balance. So 12 lakh euros, 12 lakh euros. Because this company's functional currency is euros, so this will be preparing or passing the journal entries in euros only. So no conversion required. In the books of parent company, conversion was required because transaction was happening in euros, but functional currency was INR, right? Now, in the consolidated financial statement, so now parent company will be preparing the CFS. So in the consolidated financial statements, receivable and payable in respect of the above mentioned sale or purchase between M and the G Limited will get eliminated, right? The closing stock of G Limited will be recorded at the lower of cost or NRV. Now, cost is what? 12 lakh euros into 83 rupees was the exchange rate. So 996 was the amount. NRV, because not given in the question, so we are assuming that NRV is the same. So when it will be reinstated at 85, so amount gets 1020, but we will consider cost or NRV as same, so there is no write-off required, right? So at least there wouldn't be any write-off. So what would be the journal entry in the consolidated accounts? So we will say consolidated P&L account debit by 166 lakhs to inventory account 166 lakhs. Why? Because while preparing the consolidated financial statements, we need to eliminate the intra-group transactions. Now, intra-group transaction is the purchases made by the subsidiary company from the parent company on which parent company has earned a profit element of 166 lakhs. Now, while preparing CFS, this needs to be eliminated, right? Profit element, right? Because I cannot earn profit by making sales to myself, because from the perspective of the group, this transaction of purchase and sales is happening within the group. So by the group to the group. So I cannot sell my inventory costing rupees 830 lakhs to myself at 996 lakhs and making a profit of 166 lakhs in my P&L. Hence, while preparing CFS, this will be eliminated. So this is a normal rule as per India's 110, right? India's 110. So this elimination will take place. Now, we have discussed accounting treatment in the books of M Limited, G Limited, and the consolidated financial statements, right? So, and supported our journal entries. I hope this is clear. Okay. Now, the next question is, next concept is difference in reporting dates. Now, sometimes it happens that parent company is preparing the financial statements, say for December year end, and subsidiaries preparing, say for June year end or September year end or March year end, or say for that matter, any other month year end, say October year end, November year end. So it could be any, right? In different countries. Now, if parent company needs to prepare the consolidated financial statements, that consolidated financial statement has to be prepared for a particular period and on a particular date. Now, if parent company is preparing the, suppose if parent year end is December 31 and subsidiary or the foreign operation year end is, say, June, right? June 30th. Then can parent company prepare a consolidated financial statement for December using the June financials? No. So either the subsidiary company has to prepare another set of financial statements for the December to make it a consolidation fit, right? Or something else needs to be devised, because two different dates financial statements cannot be consolidated. Now, what are the rules or relaxations around this? When there is a difference in the year end of the foreign operation and that of the reporting entity, the foreign operation often prepares additional financial statements as of the same date as the reporting entity's financial statements, right? This is the general rule. What we discussed, when there is a difference in the year end of the foreign operation and that of the reporting entity, the foreign operation generally, often means generally, prepares additional set of financial statements. So one, it is already preparing as for the year end it is having, and one it will be additionally preparing just for sharing it with the parent company so that they can prepare the consolidated financial statements. So additional set of financial statements will be prepared as of the same date as of the reporting entity. That is, June it is anyway preparing, and it will additionally prepare for the December so that parent can use that and consolidate. Now, if subsidiary company or the foreign operation is not preparing that additional set of financial statements, then what is the another, you know, possibility we can, you know, have in this case. When such financial statements are not prepared by the foreign operation or the subsidiary, Ind AS, which Ind AS 27 allows the use of a different date provided difference is no greater than 3 months, and adjustments for the intervening period for all the significant transactions are given effect. So difference shouldn't be more than 3 months. So if parent is having December as the financial year ending, then foreign operation or the subsidiary should be having September. So if it is having anything more than September, so if it is having say August or July or June or any other month, then it will be more than 3 months gap, and hence it will not be allowed. So separate financial statements needs to be prepared for a consolidation fit. But if the period is up to 3 months, right, then what we can do, we can use this September financial statements and do plus minus of significant transactions for these 3 months happened in the books of the foreign operations, and we will come up with the you know adjusted September financials reflecting some effect of the significant transactions. Then that financial will be used for the by the parent company for the consolidation, right? In such case, the assets and liabilities of the foreign operation are translated at the exchange rate at the end of the reporting period of the foreign operation. So foreign operations reporting period is September, right? So September date, September 30th, forex rates will be used. Correct? So as such, this was not a big concept. It is already there in Ind AS 27. We just revised what the Ind AS 27 is talking about around this, just for the sake of our revision and understanding that if foreign operation has a different date, then what are the possibilities we have. All right. Although this concept does not have any relation with Ind AS 29 or Ind AS 21, right? So this is all a matter of Ind AS 27, right? Goodwill and fair value adjustments arising from a business combination. So this is one another small concept. Whenever the goodwill is there in the books of the foreign operation, then while preparing the consolidated financial statements, how that needs to be taken care, right? Now, what the standard business combination says, that goodwill is accounted for on the acquisition. So goodwill and the fair value acquisition accounting adjustments arising from a business combination, that is Ind AS 103, are treated as assets and liabilities of the foreign operation, right? Hence, they are expressed in the functional currency of the foreign operation. Yes or no? Yes. And should be translated using the closing rate, as is the case for other assets and liabilities. So the manner in which other assets and liabilities will be translated from the foreign operations functional currency to the parent's functional currency, same way goodwill will also be translated. That's what the concept is saying. Let's do a quick question on this. Global Limited, an Indian company, acquired on 30th September 2001 70% of the share capital of the Mark Limited. Okay. So Global Limited and Mark Limited. So Global Limited has acquired 70% equity capital on 30th September. An entity registered as a company in Germany. So ये Germany. The functional currency of Global Limited is rupees. So INR. As its financial year, and its March year end, and year end is 31st March 2002. Okay. The fair value of the net assets of the Mark Limited was 23 million euros. So its functional currency is what? Euro. and net assets value is 23 million. And the purchase consideration paid by the Global Limited is 17.5 million euros on 30th September. So this is the fair value of the net assets and this is the purchase consideration paid. The exchange rates on 30th September 2001 was 82 per euro and 31st March 2002 was 84 per euro. What is the value at which goodwill has to be recognized in the financial statements of the Global Limited as on 31st March 2002? So at what value goodwill will be recognized as on 31st March 2002 financial statement in the books of Global Limited? Now, what we have understood in the previous slide, goodwill will be expressed in the functional currency of the foreign operation should be translated at the closing exchange rate, as is the case for other assets and liabilities, right? So para 47 of India's 21 requires that goodwill arose on a business combination shall be expressed in the functional currency of the foreign operation and shall be translated at the closing rate in accordance with paragraph 39 and 42. In this case, the amount of goodwill will be as follows. So first of all, how much purchase consideration we are discharging is 17.5 million, right? What would be the NCI? 23 million net assets into my 30% because purchase consideration is discharged for 70%. So for 30%, we will be recording the non-controlling interest NCI, and that NCI will be the 30% of net assets, right? So we are receiving net assets. So net assets debited by 23 million. Purchase consideration discharged to bank by 17.5 million and to NCI 23 million into my 13%, 6.9 million. So balancing figure would be the goodwill, right? How much? 1.4 million. So as of now, we are not doing anything new. This is what we have been doing under Ind AS 103. So till now, this is all Ind AS 103, right? Now, what Ind AS 21 requires? Goodwill on reporting date should be 1.4 million euros into my 84. So 1.4 million is the goodwill recognized initially on the acquisition date. Now this needs to be reinstated. So at 84. So this would be 117.6 million. How much? Rupees. So 84 rupees is the per euro rate as on the closing date on which the financial statements are being prepared. So it will be reinstated for that purpose. And 117.6 million would be the INR amount. INR, right? In the books of the parent company, because parent company is having the functional currency in INR. So the only application of Ind AS 21 is this, right? Till here it was all 103 and this is 21. Clear? Okay. Next concept, disposal oblique partial disposal of the foreign operation. Now, as we previously discussed, that whenever the parent company disposes of, the interest in the subsidiary company or the foreign operation. So on the disposal, whatever accumulated forex exchange gain or loss is there will be reclassified from the OCI to PNL or equity to PNL because that has already been recorded in OCI and accumulated there. Now, let's do a detailed analysis of this. In what situations, what needs to be done. So disposal or partial disposal of a foreign operation. So either it will be a full disposal or it will be a partial, right? Now, if disposal of an entity entire interest, that is full disposal, then what will happen? Reclassify from equity to PNL, right? that we have already discussed earlier as well. So as a reclassification adjustment, the cumulative exchange difference recognized in OCI and accumulated in a separate component of equity. So, right. So this is all will be reclassified. Now, if disposal is not full and it is a partial disposal, and there are two scenarios, either the foreign operation was the subsidiary or the foreign operation was not the subsidiary. So other than subsidiary, it could be either a JV or an associate, right? So if it is a subsidiary, then it may involve loss of control, or it may involve not a loss of control. So if it is a loss of control, then de-recognize and reclassify, de-recognize but shall not be reclassified to the P&L, the cumulative amount of the exchange difference attributed to the NCI, non-controlling interest. So in this case, what will happen? We will de-recognize the subsidiary from our books because we have disposed of and we have lost the control. It will be now only an investment, but we are losing the control over the subsidiary. So going forward, we will not be, consolidating it. But if there is any interest left, that will be treated as an investment only in the standalone as well as the consolidated financial statements, because there wouldn't be any more consolidation because we lost the control on the subsidiary. Now, in this case, what will happen? We will de-recognize the subsidiary from our books, but we will not reclassify any cumulative amount of exchange differences to the P&L pertaining to the NCI. If it involves partial disposal of the subsidiary without loss of control, right? So either it will be a loss of control or it will not be a loss of control. So if loss of control, we will de-recognize. If there is no loss of control, then what we will do? We have sold some port of some investment in the subsidiary, but still we are having control. So we will continue to consolidate the subsidiary, right? For example, we were having a 70% interest. We have sold 10%. Still we are retaining a 60% interest in the subsidiary. Hence, it will continue to be our subsidiary. Now, what we will do? Reattribute the proportionate share of the cumulative amount of the exchange differences recognized in OCI to the NCI in that foreign operation. What does it mean? We will only see reattribute the proportionate share of the cumulative amount of exchange gain or loss in OCI to NCI. So we will do a practical, we will understand. And if it is not a subsidiary, if it is either a JV or associate, then definitely, it is not a question of losing control or gaining control. So there wouldn't be any two scenarios like we were having in the case of subsidiary. Now, in this case, what will happen? When the retained interest after the partial disposal of an interest in the joint arrangement or a partial disposal of an interest in the associate that includes a foreign operation is a financial asset, right? Because this is a investment in JV and associate. This is a financial asset, financial instrument, that is equity investment in the JV or equity investment in the associate. So what we will do, reclassify to the P&L only the proportionate share of the cumulative amount of the exchange difference. So how much, we have disposed of in that proportion, we will reclassify from OCI to P&L. Let's do quick examples to understand the concept. Parent P owns 100% of the foreign subsidiary S. P sells 70% of its investment. Now, it is a loss of control or not a loss of control? It is a not losing control, not losing control, right? Now, where this will fall? This will fall here. Partial disposal, yes. Subsidiary, yes. Losing control, no. So we are falling here, right? What will happen? The entire balance in the foreign currency translation reserve in respect of S is reclassified to the P&L. So we had 100% investment and we sold 70%. Sorry, we are not retaining. We are selling 70%. So we will be left only 30%. So in that case, we will be losing the control. Sorry. right? Losing the control. So where we will be falling? We will be falling partial disposal, yes. Subsidiary, yes. Losing control, yes. So what we will do? De-recognize and reclassify to the P&L. So what we will do? We will reclassify the entire balance into the P&L of foreign exchange gain or loss sitting in the balance sheet. Next scenario, parent P owns 100% and sells 10% of its net investment and retains or continues control over the subsidiary. Therefore, 10% of the balance in the foreign currency translation reserve is reclassified to NCI. So earlier, I was owning 100%. I have sold 10%. So it means partial disposal, yes. Subsidiary, yes. Losing control, no. So where we are falling? So partial disposal, yes. Subsidiary, yes. Losing control, no. So we are falling here. So we will do a proportionate adjustment from the cumulative foreign exchange gain or loss from OCI to NCI, non-controlling interest. So we will create a 10% NCI instead of having 100% OCI, right? Now, third scenario, parent P owns 35% of the foreign asset B. P sells 5% stake. So 35% we are having and 5% we are selling and retains significant influence over B. So SI is retained, right? Therefore, 1/7, that is 5% divided by 35. So 1/7 of the balance in the foreign currency translation reserve will be reclassified to the P&L, right? So proportionate share we will reclassify. Let's do a quick question. Parent P acquired 90% of the subsidiary some years ago. Now P sells its entire investment in S for rupees 1500 lakhs. Okay, so entire stake has been sold. So we are losing control, right? The net assets of S are 1000 and NCI in S is 100 lakhs. So 90% stake we had purchased, right? For rupees, how much? 1500 lakhs. And net assets are 1000 lakhs and NCI is 100 lakhs. That is the given in the question, right? The cumulative exchange difference that have arisen during the P's ownership are of 200 lakhs. So 200 lakhs is the foreign exchange gain or loss accumulated during the period, right? In P's foreign currency translation reserve in respect of S having a credit balance of 180 lakhs. So because 200 lakhs have been the total gain or loss, so 90% of that, that is 180 lakhs, 200 into 90%. So 180 lakhs is, the accumulated credit balance in respect of P's interest in S, right? While the cumulative amount of exchange difference that have been attributed to the NCI is 20 lakhs. So this 200 lakhs has two shares, 90% share of the parent company, that is 180 lakhs, and 10% of the NCI, that is 20 lakhs, right? That is also given in the question. Calculate P's gain or disposal in its consolidated financial statement. So while preparing the consolidated financial statements after the disposal, what would be the gain on the disposal, gain or loss on the disposal in the consolidated financial statements that we need to calculate. Fine. Facts of the question are clear, I hope. Now, P's gain on disposal in its CFS are calculated in the following manner. So what is the sale proceeds? 1500 lakhs. So P now sells its entire investment in S for 1500 lakhs. So 1500 lakhs is the receipts which we are getting by selling the 90% stake in the subsidiary. As on date, net assets of S are 1000 lakhs, so that we will deduct. We will add the NCI, non-controlling interest, which we have de-recognized, so 100 lakhs. And foreign currency translation reserve credit balance, 180 lakhs. So the net gain on disposal would be 780 lakhs. Simple question. Simply, we just need to calculate the gain on disposal, right? So gain on disposal is whatever the proceeds we have received minus the net assets we are, discharging, NCI we have, de-recognized, and the credit balance of the foreign exchange. Had this been a debit balance, then this would have been deducted, right? So because it is a credit balance, so this is added. Hope the solution is clear. It was an easy solution. Now, there are certain points which we need to, keep in our mind. A write down of the carrying amount of a foreign operation, either because of its own losses or because of impairment recognized by the investor, does not constitute a partial disposal. Of course, even if the standard does not say this, we would know this. So in this case, write down is happening or impairment is happening. It is not to be considered as disposal, right? So a standard is saying if there is an impairment, then please do not consider impairment as disposal. Of course, disposal means selling the interest. Impairment means bringing down the carrying amount of the investment in the foreign operation on account of impairment, right? So that is different from disposal. So standard just trying to be more expressive to avoid any confusions. Although even if the standard would have been silent on this, this wouldn't be making any, difference at all, because write down cannot be equal to the disposal, right? Now, so standard is saying because we are doing write down and we are not, doing the disposal of the foreign operation or selling the foreign operation, so no part of the foreign exchange gain or loss recognized in OCI is reclassified to PNL at the time of the write down. So whenever we record the write down, we do not need to do a disposal accounting, right? Disposal accounting has to be done at the time of disposal only, not at the time of write down, because this is a just write down of the carrying amount, not a disposal. Now, so far we have covered, the definitions of the foreign currency, functional currency, and the presentation currency. Then we have discussed monetary items, non-monetary items. Then we discuss how the monetary items will be reinstated and how the exchange gain or loss will be recognized on monetary items, always in the profit and loss. Then we discuss for all the non-monetary items like property, plant, and equipment, inventories, intangible assets, investment property, prepaid expenses, all such non-monetary items which do not have contractual right to receive cash or other assets, right? So they are regarded as non-monetary item, and if they are in the functional currency, liabilities pertaining to those are in foreign currency, then reinstatement happens on non-monetary items provided they are fair valued, and if fair value gain or loss goes to PNL, then exchange gain or loss will also go to the PNL. If fair value gain or loss goes to OCI, then exchange gain or loss will also go to the OCI. So basically, Ind AS 21 says, boss, for monetary item, any exchange gain or loss will always go to the PNL. But for non-monetary item, any exchange gain or loss will follow to the fair value path. So if fair value is being recognized in OCI, because of revaluation model under Ind AS 16 for the property, plant, and equipment, if the revaluation is a upward revaluation, then it always goes to OCI, right? So in that case, gain or loss on foreign exchange item will also go to the OCI. If downward revaluation is done and it is hitting the PNL, then fair valuation gain or loss will also hit the PNL, right? So that we had already discussed in our previous session. Now, thereafter, we discussed that there could be two scenarios where a company would be required to translate its financial statements from one currency to another currency. One scenario could be when when company wants to present additional set of financial statements in any other currency other than the functional currency, right? For example, an Indian company is preparing the financial statements in INR, but they also want to present the same financial statements, say in dollar. then they will be, once their financial statements are completed and prepared in INR, they will be simply applying India's 21 on that, converting the set of financial statement into the dollar currency, right? So that conversion or transition will be guided by this standard. So that is the one scenario where companies wants to prepare additional set of financial statement in any other currency, which will be termed as presentation currency, right? Another scenario could be where company is preparing the consolidated financial statement, and now parent company is having a different functional currency and foreign operation is having a different functional currency. So in order to prepare CFS, consolidated financial statements at the level of the group, parent company would be needing the financial statements of the foreign operation duly converted into the same currency as to what functional currency of the parent company, right? So in that case, there would be a translation of the foreign operations financial statements into the functional currency of the parent so that they are fit for consolidation and consolidated financial statements can be prepared, right? So these are the two scenarios under which translation of the financial statements needs to be done. Now, we have discussed the translation approach. Under the translation approach, we have discussed that there would be balance sheet items, there would be P&L items, and there would be equity items. So all the balance sheet items will be translated for the current year balances at the current year rate, for the previous year balances at the previous year closing rate. For the P&L items, it would be the average rate for the current year, and for the previous year, it would be the average rate for the previous year, correct? And for the equity items, it would be the average rate for the current year and average rate for the previous year for the preceding items. Now, we are set on the path to, do a full-fledged translation question. So whatever the rules, concepts we would be requiring to, solve or do this translation, we have already discussed them. We have done a lot of practical questions around that. Now it's time to try our hands on a full-fledged translation question. Okay. Infotech Global Limited has a functional currency of USD and needs to translate its financial statements into the functional and the presentation currency of the Infotech INC L dollar. Okay. The following balances appear in the books of the Infotech Global Limited for at the year end prior to the translation. So before translation, this is the balance sheet of the Infotech Limited and whose functional currency is US dollars, right? And Infotech INC's functional currency is L dollars. Okay. So this is given the balances. For example, PP&D $50,000, receivables $9,35,000, total assets $9,85,000, issued capital 50,000, opening retained earnings, profit and loss for the current year, accounts payable, accrued liabilities, and total equity and liabilities. So this is the balance sheet given, right? Translate above balances of the Infotech Global Limited into my L dollars ready for the consolidation by Infotech INC, right? So Infotech INC is the parent company and Infotech Global is the foreign operation or the subsidiary company, right? Now, this Infotech INC is asking its foreign operation boss, I have this functional currency, you have US dollar as the functional currency. I need to prepare a consolidated financial statement. Hence, I need your financial statements into my functional currency. So this is the financial statements given in the functional currency of the foreign operation. Now this financial statements needs to be converted into this currency. That is the question, right? Also prepare a working of the cumulative balance of the foreign currency translation reserve. Additional information. Relevant exchange rates are rate at the beginning of the year, rate at average rate for the year, and rate at the end of the year. Now, how the translation will take place? Translation of balances for the purpose of the consolidation. So this is the USD balance sheet, this is the rate, and this is the functional currency of the parent company balance sheet balances, converted balances. So this is the three columnar approach you need to take in the examination approach. For the sake of simplicity, just list down the items in the same order as given in the question and amounts as given in the question. Then accordingly you apply whichever rate is the appropriate rate, and then multiply and convert and show up the balances in the new currency like this. Okay, so it will save your time and it will always be a easy presentation to understand for the paper checker as well, right? Now, property, plant and equipment 50,000, rate 1.13. Why 1.13? So rate at the year end is 1.13, right? So this is being used here, and the converted balance is this much. Receivables 9,35,000, rate 1.13. So this is the converted balance. Total assets, then issued capital 50,000, no conversion. Share capital is not converted. Retained earnings is not converted. Then profit for the year. So for the year, this is a P&L item. So average rate we will be using. What is the average rate? Average rate for the year is how much? This 1.175. And this is the question from your study material only. So you can, refer to the study material as well. So this is the average rate we have used, multiplied, and this is the amount, right? Now, accounts payable, again, closing rate, liabilities, other liabilities, again, closing rate, and this is the total equity and liability total, right? And here we will also total it up, right? Now, foreign currency translation reserve, we need to, account for that. We will discuss how this is arriving. And then lastly, the equity and liabilities total we will be giving up here, right? Now, so our balance sheet is tallied here, right? Same amount of the assets, same amount of the equity and liabilities. Now, this we need to talk about how this is coming up. So, amounts translated in new currency is issued capital, opening balance, opening retained earnings, and profit for the year 62,350. From where it is coming? So issued capital is this much, opening retained earnings is this much, right? So this is carried forward here. Here it is, here it is. And profit for the year is coming from the previous calculation here. So profit we have on 20,000 in USD converted at the average rate. So this is the amount of the profit for the year duly converted in the new currency. So this would be the closing balance, 62,350. That 62,350, is the closing balance. Now, 44 to 48 is the amount of the issued capital, 50,000 multiplied by the closing rate, then opening retained earnings multiplied by the closing rate, and then profit for the year multiplied by the closing rate. So this would be the amount, 86,726. Now 86,726 is put up here, right? And then we have come up with the difference. So by doing this, this would be the amount, and by conversion, this would be the amount. So whatever is the delta will be sitting in the foreign currency translation reserve account, foreign currency translation, cumulative balance in the foreign currency translation reserve account. So this is the 24,376 is FCTR reserve that we need to, add in our other equity here in order to reconcile our balance sheet. Then balance sheet will be reconciled, right? So this is how the translation procedures needs to be performed. So given the balance sheet, we will apply the corresponding average rates or the closing rates basis on the nature of the item. If it is a balance sheet item, closing rate. If it is a P&L item, average rate, right? And then we will calculate the delta between the issued share capital and the reserves and the profit earned. So delta of these two items will be, there in the foreign currency translation reserve. which will form part of my other equity. So it will form part of my other equity, right? Here in the balance sheet, and my converted balance sheet will be reconciled, right? Now, the doubt or the question you should be asking is why property, plant and equipment being a non-monetary item is converted, right? So we have discussed that non-monetary items, are converted, translated, and the foreign exchange gain or loss will go to the P&L or the OCI, where the fair value gain or loss goes. And if it is kept at cost, then there wouldn't be any conversion required, right? So since the question is silent, and we just want to showcase that we know that non-monetary items, if converted, then gain or loss is recognized. So we have assumed here that this is at revaluation model. This is at revaluation model. Okay. So I think this was the full-fledged question which we have just done. And I hope you have understood the concept. Now there are certain, disclosures required by this standard, which we need to talk about, because every standard, has certain disclosures. So in case of the foreign currency transaction, disclose the amount of the exchange difference recognized in the profit or loss, except for those arising on financial instruments measured at fair value through P&L as per Ind AS 109. So if there are any exchange differences, be it profit or loss, it will be recognized in the P&L except for those arising on the financial instruments measured at FVTPL. So when the financial instruments are measured at FVTPL, fair value through P&L, they are automatically required to be recognized through P&L only under Ind AS 109, right? So we just need to disclose for all other items, because for this, the disclosure will be well captured by Ind AS 107 as well, right? Which is a disclosure standard for the financial instruments. Now, net exchange difference recognized in OCI and accumulated in separate component of the equity, and a reconciliation of the amount of such exchange differences at the beginning and end of the period. Now, what is this saying? We need to present net exchange difference recognized in OCI and accumulated in the foreign currency translation reserve, which is a part of separate component of equity, that is other equity, and reconciliation with opening balance plus additions, deletions, deductions during the year, and the closing balance. So we have to showcase a movement from opening balance to closing balance of this, right? So that tabular disclosure is required to be given. In case of change in the functional currency of either the reporting entity, that is the parent company, or of a foreign operation, that is the subsidiary company or JV or associate sitting outside our domestic country, right? Now, what we need to disclose? The fact that there is a change in the functional currency. So if it is a change in the my own functional currency, I will disclose that my functional currency has been changed on account of so and so reason or change in circumstances. If my foreign operations functional currency has changed during the year, then in consolidated financial statements as well as in separate financial statements, I will say that my foreign operation functional currency is changed from dollar to Japanese yen on account of so and so reason, right? So the fact that the functional currency of the parent company is changed or the foreign operation is changed needs to be disclosed. Then reason why this change has occurred, that needs to be disclosed, and the date from which date this new functional currency has become applicable. So three items needs to be disclosed: the fact that there is a change, the reason why there is a change, and the date from which there is a change, right? So three items which we need to disclose about as and when there is a change in the functional currency. when the presentation currency is different from the functional currency. So if now at the start of the session, we have talked about there are three types of currencies: functional currency, foreign currency, and the presentation currency. Functional currency is the currency in which company, in whose country economic environment company operates, right? That is the functional currency. And then we have discussed primary indicators, three primary indicators, two secondary indicators, and four additional indicators for the foreign operation. So all in all, 9 conditions, criterias, or indicators, whatever name you call it, those have to be considered for the determination of the functional currency, right? Once the functional currency is determined, then I will be recording all my journal entries or doing preparing my books of accounts and the financial statements in my functional currency by default. But on the top of that, if I want to present additional set of financial statements over and above my functional currency, and suppose I select, say, any other currency, then that currency in which additional set of financial statements are being prepared and presented will be regarded as the presentation currency, right? Now, if I am doing so, that is, I am presenting additional set of financial statements in any other currency other than the functional currency, which is regarded as a presentation currency, then there would be some additional disclosures which would become applicable in this case that I need to disclose. What are those? Number one, the fact that the presentation currency is different from the functional currency. So first of all, I say, boss, my functional currency is INR, but I am preparing additional set of financial statements in the USD, and my presentation currency USD is different from my functional currency INR. This fact I will be disclosing in my USD financial statements, right? That is the presentation currency financial statements. Number two, disclosure of the functional currency. Then I will say INR is my functional currency, although I am preparing my financial statements in the dollar. That is the presentation currency. Then reason why I am not preparing my financial statements in the functional currency, but preparing in the financial statements in the presentation currency. Reason. So I will tell whatever the reason is for this purpose. So suppose I may say that although for my legal requirements and reportings, I have already prepared my functional currency financial statements and get them audited, submitted to whatever the regulatory authorities are, and I am preparing this additional set of financial statements in presentation currency for the sake of submitting them to my prospective investors who would like to see my financial position or financial statements in, say, this particular currency, dollar, euros, GBP, whatever. That is the purpose of preparing the financial statements in presentation currency. So that reason I have to disclose in my disclosures in the presentation currency financial statements. Description that the financial statements is complying with all India's. So this reserve, explicit and unreserved statement also needs to be given in the financial statements of if prepared in presentation currency. So what I will say that, boss, I am preparing these financial statements in dollar, which is a presentation currency, while my foreign functional currency is INR. Now I declare that financials prepared in dollar currency, that is the presentation currency, are in compliance with all the accounting, measurement, recognition, and disclosure requirements of all the indices, right? So that disclosure I need to make. So whenever we prepare the financial statements in the presentation currency, these are the additional disclosures I need to give in that financial statement set, which is prepared in another currency, called as presentation currency. I hope this disclosure is clear, but this disclosure gets activated only if we prepare financial in presentation currency, otherwise not, right? Now, in case financial statements are not in compliance with all the indices, like, then what we need to do? So if I say that financials are prepared in presentation currency, but I have deviated from some of the requirements of the indices, then what need to do? Number one, clearly identify the information as a supplementary information to distinguish it from the information that complies with the Ind AS. So I will say what all information in this financial statement is not in line with the Ind AS requirements, that will be regarded as a supplement information or additional information, right? Disclose the currency in which the supplement information is displayed. That is the presentation currency only, dollar in our example. And disclose the entity's functional currency and the method of translation used to determine the supplementary information. That is the INR is the functional currency, and how the translation has been done, that I will disclose, right? So I can present that table, that my INR balances, my exchange rates, and my closing balance, reinstated balances. So that tabular representation, which we have just done in our previous question, practical question, same format tabular presentation I can use to disclose that how the translation has taken place from my functional currency financial statement to my presentation currency financial statement, right? So this is the additional item gets triggered if I say that my presentation currency financial statements are not complying with all the NDSs, right? So number third disclosure, is a disclosure situation based, right? This is not a disclosure you will find in every company's financial statement, because this becomes activated or applicable only if presentation currency is being used to present the financial statements. So that's all on the disclosures around this standard. Now, differences between Ind AS and IGAP. So there are definitely certain differences between Ind AS and IGAP. Which standard is there under IGAP? AS 11, which we have been studying and applying in our practical life so far. And we know that AS 11 talks about similar concepts or similar things, but still there are some differences that we need to discuss here. So, forward exchange contracts and other similar financial instruments. Forward exchange contracts and other similar financial instruments excludes from its scope forward exchange contracts and other similar financial instruments which are treated in accordance with Ind AS 109. Now, what it is saying, Ind AS 21 excludes from its scope forward exchange contracts and other financial instruments which are within the scope of Ind AS 109. So as you know that Ind AS 109 covers the derivative accounting, that is forward, futures, options contracts are treated as derivative contracts and hence are accounted for under Ind AS 109 at what measurement? FVTPL, right? So because they are covered already by Ind AS 109, so Ind AS 21 specifically excludes them, right? And that we had discussed in our previous session when we have, discussed the scope and scope exclusions for Ind AS 21, right? Now, under AS 11, all these are includes accounting for such contracts. So AS 11 does not exclude from these types of contracts from its scope, because under IGAP as such there is no corresponding standard for financial instruments, although there is, but that was not notified. So AS 11 covers the accounting for these contracts as well, right? So that is the one difference between the two standards. Then exchange differences arising on translation of certain long-term monetary items from foreign currency to functional currency, right? What it is saying, exchange differences arising on translation of certain long-term monetary items from foreign currency to the functional currency. Now, Ind AS 21 does not apply to the long-term foreign currency monetary items recognized in the financial statements before beginning of the first India's financial reporting period as per the previous gap, that is AS 11. However, as provided in India's 101, such an entity may continue to apply its old accounting policy they were following in the IGAP, right? And this concept we have discussed in our previous session when I talked about India's 101 specific exemption, right? And I also mentioned that India's 101 is a first time adoption standard and it is applicable only once in the lifetime of a company, right? And it applies only on the first transition or first time preparation of the India's financial statements when the company, applies India's first time. Now, during that application, this standard has certain exemptions and exceptions. One of the exemption is that it can continue its old accounting policy under AS 11. Continue old accounting policy opted for long-term foreign currency monetary items as per the previous gap. Previous gap means AS 11, right? So under India's 21, because accounting policy is different, India's 21 does not provide this opportunity. So India's 101 only you know relaxed the companies or given an exemption to the companies at the time of first time adoption as a choice whether you want to continue the old accounting policy as per AS 11 in your India's financial statements for the old items or you don't want to continue, right? So if the company opts that yes, whatever we have been doing under AS 11 for these long-term monetary items, we will continue to do until these long-term monetary items are de-recognized from our balance sheet. So that option is availed. Then that accounting policy of IGAP will continue in the India's financial statements only for those items which were there on the transition date. But if similar non-monetary items comes up or are recognized because of transactions happening after the transition date, then this exemption will not apply and India's 21 accounting policy will apply, right? So this is another gap because of this India's 101, right? If India's 101 does not provide any such relaxation, then this wouldn't have happened here. Now, AS 11 gives an option to recognize exchange difference arising on the translation of certain monetary long-term monetary items from foreign currency to the functional currency directly in equity, right? In to be transferred to profit and loss over the life of the asset or liability if such items are not related to the acquisition of fixed assets. When such items are related to the acquisition of fixed assets, the foreign exchange differences can be recognized as part of the cost of the fixed assets. That is the capitalize. Right? So, foreign exchange gain or loss on the vendor payable for the purchase of fixed asset will continue to be capitalized to the fixed asset as per AS 11 that is allowed, but under India's 21, it will not be allowed. And for other liabilities, it will be amortized from equity to the PNL over the life of the liability, but it is not allowed under India's 21. So this accounting policy of AS 11 can be continued on old items if entity avails exemption given under India's 101. That's what is the point here. Now, definition of the functional currency. Definition, functional, and the presentation currency. Functional currency is the currency of a primary economic environment in which the entity operates. Right? That we have discussed as a part of definition. Foreign currency is the currency other than the functional currency, right? Once functional currency is determined, rest all currencies will be foreign currency. And presentation currency will be the currency in which the financial statements are presented. So presentation currency would be one of the foreign currency in which the financial statements are presented. So there are three concepts or three types of currencies under India's 21. But under AS 11 IGAP, there is no concept of the functional currency and the presentation currency. Only the item foreign currency is defined is the currency other than the reporting currency, in which currency the financial statements are presented. So AS 11, defines foreign currency in a different way and does not define functional currency, does not define presentation currency. So that is the difference between India's 21 and AS 11, right? So there are all in all three major differences which we have just discussed. Now, as far as India's and IFRS, that is India's 21 and IAS 21 is considered, there is no gap difference, right? However, there could be one just because of this exemption of India's 101, right? As such, there is no direct difference between India's and the IFRS series, correct? So that was the key differences. Now, I think I can take a break for 10 minutes and then I will resume with the questions on this recording.
ब्रेक स्टार्ट करो सर।
हाँ, ब्रेक कर दो 10 मिनट्स।
ओके सर, ब्रेक स्टार्ट।
Okay. Uh, let's resume our session after the break.
Continue.
Ready?
Yes, sir. Please continue.
So as we have talked about, there are certain gap differences between the Indias and the corresponding IGAP AS11, and there are as such no difference between the Indias and IFRS series. Now let's try our hands on some important MCQs that we have, on this standard. So as per the Indias 21, the effects of changes in the foreign exchange rates, the term used for the foreign currency of the primary economic environment in which the entity operates is dash currency. So which currency is this? So now we need to recall whatever the definitions we have studied and understood. So there are all in all three types of currencies defined by this standard. Number one is functional currency. Functional currency is the currency in of the country in which prime economic environment the entity conducts its business or operates, right? Foreign currency is the currency other than functional currency. So once the functional currency is determined, rest all currencies will be by default foreign currency. And presentation currency is the currency in which financial statements are prepared and presented. So presentation currency will be that currency in which the financial statements are being prepared and presented. It can be functional currency or it can be other than functional currency, right? If it is functional currency, then functional currency and presentation currencies are same. If it is not the functional currency, then it could be one of the foreign currency, right? So that currency would be foreign currency as well as the presentation currency. Now, what would be the answer? So the answer would be functional currency. Why? Because the currency of the primary economic environment, right, in which the entity operates is functional currency. This is the definition of the functional currency given by the standard, right? Although it was an easy one, let's try this. The currency that is most internationally acceptable for trading would be relevant in determining the entity's functional currency as per India's 21. True or false? Now, what would be the answer? Just I'm giving you a chance so that whenever you try done with the answer, I can, discuss what would be the answer. So question is most internationally acceptable currency, right? Would be the functional currency. Yes or no? Of course, false, no. So now we need to go back to our primary indicators. Then secondary indicators, right? So primary indicators were 3, 1, 2, 3, and secondary indicators were 2. So all in all, these 5 indicators, out of these 5, none of the indicators says this, that most internationally acceptable currency would be the functional currency, right? So hence, this statement is false, correct? Let's do this MCQ. Parent P owns 80% of the net assets of the subsidiary S. So parent P owns 80% of the net assets of the subsidiary S. So P is the parent, S is the subsidiary, and it owns 80%, right? S functional currency is dinar. Okay. S was acquired on 30th September 2011. So 30th September 11. And its net asset fair value was 40,000 dinar. So net assets were 40,000 at that time. Okay. P has recognized cost of investment amounting to US dollar 10,675 in its financial statements. Now, P has recognized cost of investment of amounting how much? US dollar 10,675. The group's accounting policy for goodwill is to recognize it on a proportionate basis. So under India's 110, you must have studied that goodwill either can be recognized at full consolidation basis, full method, or the proportionate, right? Now here the facts of the question says it is opted to be proportionate. Exchange rates are as follows. 30th September 2011, USD 1 is equal to 6.5 dinar. And as on 31st December 2012, USD 1 is equal to 6 dinar. Calculate the goodwill to be recognized in the consolidated statement of financial position as on 31st December 2012 under India's 21. Right? So this is the question. Now, before you start doing calculations, let's recap the related concept we have discussed, which will be helpful here. So the concept is goodwill fair value in the functional currency of the foreign operation needs to be reinstated, right, on the closing date. What is the closing date? Is the date on which the financial statements are being prepared, that is 31st December 2012. So on this date it will be reinstated. Now this is the MCQ, but it is involving all the concept application and the calculations. So you see the level of quality of the MCQ, right? So if your concepts are clear, you don't need to give any sort of presentations or working notes. Only you need to pick up the right answer and a one-liner reason that why this is correct, and you will get good marks. So now I'm giving you option to try on this, and then we will discuss the answer. Okay, I hope you must have tried and come up with the answer. So let's see what is the correct answer. So the answer is option D. So USD 6231 is the correct answer. And what we were expected to do, calculate the goodwill to be recognized in the consolidated financial as on 31st December. So we have to calculate the goodwill amount which would be there in the consolidated financial statements as on 31st December 2012. Now let's see how this calculation must have been done for answering this MCQ. Original cost of investment is given in this question, 10,675 US dollars into my 6.5 is the conversion rate which will be applied. That is given here on the date of 30th September 2011, which is the date on which the investment was made, right? So 6.5 we have multiplied. Cost of investment at year end, exchange rate. How much? So this amount divide by 6. So 11,565 would be the USD, the cost of investment on the year end date. Now, net assets acquired in USD at the year end exchange rate is how much? 40,000 divided by 6. 40,000 is given in the question. That is the amount, fair value of the net assets as on that date, on the date of acquisition, divided by 6. 6 is the rate on the year end. So we will simply divide 40,000 divided by 6. So 666 and 7 is the USD amount of net assets on the closing reporting date. Now, group share is how much? 80%. So 667 into my 80%, 5334 would be the group's share, right, in the net assets. Hence, goodwill will be 11,565. That is the cost of acquisition minus share in the net assets 5334. So 6231. So 6231 will be the goodwill. That's why option D. Right. Now, do we need to present all these calculations if suppose this MCQ was there in the examination? Now, ideally, we are not supposed to give all the calculations, but if you have time and you want to support your answer, then probably you can quickly, give that group share is equal to this 80% of this, and this is calculated how? This way. So basically you can do all the calculations in single line and present it, provided you are versed with the concepts. Otherwise, definitely you can present the step calculations, although it will take some extra time, but it will be easier for you as well as the examiner to understand what you are trying to do in the solution, right? But anyways, if your answer is correct, either by giving the whole presentation of solution in the MCQ or just by giving a simple one-liner calculation, anyway you will be getting the full marks provided answer is correct, right? So that is your choice and you can decide upon. Let's do this one. In the context of the IND-AS 21, the effects of changes in the foreign exchange rates, monetary items are units of currency held and the assets and liabilities to be received or paid in the fixed or determinable number of units of the currency, right? So this is the definition of the monetary items. We have already studied when we studied what are the monetary items, what are the non-monetary items and examples of them. Now, which of the following is not a monetary item? Just try. Once you are done, I will discuss the solution or the answer. As such, no solution here. Okay. Cash and bank balances. Are these monetary items or not? So monetary items are the currencies held, and cash and bank balances are nothing but the currencies held. So this is a monetary item. Fixed deposits. So fixed deposits are deposits held with the banks or any other company, right? Or NBFC. Now they have contractual right to receive. So they have uh, clear amounts of money which will be receivable. Hence, these are also monetary items. Shareholders' equity. Now, shareholders' equity. Does the shareholders have the right to receive money? Yes, they have the right to receive the money. But when? Today or on winding up of the company or liquidation? On liquidation. So they do not have the right today. So they have the right only upon liquidation, right? So, and do they have clear amounts of money which they will be receiving? No, they will be receiving whatever is left after discharging all the liabilities. Hence, it is not a monetary item, right? Accounts payable, clear amounts of liability, monetary item. So these three are monetary item. Shareholders equity is not the monetary item, right? Clear? Because equity is the equity shareholder is does not have any right to claim anything from the company until liquidation or winding up, right? So they have the right in the uh, residual interest in the assets of the company, right? Residual interest in the assets means whatever is left after just discharging all the liabilities, whatever the company is having in their balance sheet. Okay, let's do this one. Z Limited imported an item of PP&D costing $1 lakh. So Z Limited has imported what? Machinery of $1 lakh. The forex rate at the date of the receipt of the PP&D in India was INR 60 to $1. However, at the time of remitting the payment to the foreign vendor 30 days after the receipt of the PP&D in India, the forex rate was 62. So at the time of purchase, forex rate was 60. At the time of payment, forex rate was 62. Accordingly, Z Limited passed a journal entry debiting the vendor account for 60 lakh, debiting the exchange loss for 2 lakh, and crediting the bank account for 62 lakhs. So it said, sorry, machinery account debit, loss account debit to bank, right? 60 to 62. This is the entry company has posted. At the first balance sheet date, after the acquisition of the aforesaid PP&D, Z Limited opted to use the revaluation model. So revaluation model is under Ind-AS 16, right? Under Ind-AS 16, revaluation model is being used. The accounting treatment as per Ind-AS 21 as regards to the exchange loss of INR 2 lakh is 2 lakh being a realized forex loss on a monetary item should be recognized in the P&L. 2 lakh being unrealized forex loss on a monetary item should be recognized in P&L. 2 lakh being a realized loss on non-monetary item should be recognized in P&L, or 2 lakh being realized loss on a non-monetary item should be recognized in OCI as the asset is being accounted for under the revaluation model. So machinery has been purchased for 1 lakh US dollars when the rate was 60 rupees per US dollar, and the payment was charged on the date when the rate was 62 rupees per US dollar. Company has capitalized the machinery by 60 lakhs, P&L debited for exchange loss 2 lakhs, to bank account 62 lakhs, right? This is the entry company has posted. Now, question is asking whether this 2 lakh, which company has recognized in P&L, should be the right treatment as it was realized forex loss on monetary item, or it was unrealized forex loss on monetary item, or it was a realized forex loss on non-monetary item because machinery is the non-monetary item, or it was a realized loss on machinery, non-monetary item. Hence, instead of recognizing it in P&L, it should be recognized in OCI. So these are the four options: A, B, C, or D. So you just try, and once you are done with your answer, we will discuss. So just recall whatever the concepts we had discussed when we discussed the monetary item, non-monetary item, and gain or loss on account of foreign exchange fluctuation, will go to the PNL or the OCI under what circumstances. We have done, quite some practical questions around these concepts in our previous session. So I expect you would be able to answer it correctly whenever you will be trying on this MCQs. This shouldn't be the tough one. Okay, I think you must have tried by now. Let's see what is the correct answer. So correct answer is option A. The exchange loss was suffered on the foreign exchange denominated accounts payable pertaining to the import of the machinery. Therefore, exchange loss pertains to the monetary item. And we have understood or studied the rule that whenever there is any foreign exchange gain or loss on monetary item, it always goes to the P&L, right? And furthermore, because it is already realized, right? Payment has already been made by the company. So it is a realized. So option A, 2 lakh being realized forex loss on the monetary item should be recognized in the P&L is the correct option, right? Clear? Although it would go to the P&L only even if it was not realized. So whether realized or unrealized, exchange gain or loss on the monetary item will go to the P&L. So thumb rule is for monetary items, any sort of exchange gain or loss always goes to the P&L. Now, some of you might be doubting that why we are saying it monetary item. We have purchased the machinery. Then machinery is a non-monetary item. Then why we are saying that the exchange gain or loss is on monetary item? Boss, exchange gain or loss is not happening on PP&E. Exchange gain or loss is happening on the credit balance, that is USD, which I need to pay to the vendor of the machinery, right? So machinery has already been purchased and accounted for, right, at conversion rate on the date of purchase, that is rupees 60 for per 1 USD. Now the obligation in my balance sheet is sitting to discharge the payment. On that payment, when I discharge, I incurred a loss of rupees 2 rupees because I paid at the rate of 62, right? So this 2 rupees loss I am incurring because I am doing a payment in the foreign currency. So foreign currency gain or loss is happening on the accounts payable, and accounts payable is the monetary item, right? And for monetary item, whether the gain or loss is realized or not, it will always go to the PNL. But in the facts of the question, it was said that payment has already been made, so it was realized, right? So option A would be the correct answer because it is a realized forex loss, right? Although even if the option it was not paid and it would have been unrealized, then also it will be routed through PNL only. So option B would have been correct had the payment was still outstanding, right? But basis on the facts, option A is correct because question is clearly saying payment has been made. So payment is made, so forex loss is realized, right? Okay, this is one of the exam question. Alpha, a US entity and a prominent exporter in the liquor and the wine products, has invoiced an amount of INR 1 million receivable in the month of May 2013. The spot rate on the date of the transaction was $0.018 against INR 1. So for 1 rupee INR, this much is the dollar, right? During the year end 31st March 2013, the closing rate was this much. Show the effect of the above transaction. So what is happening in here? US entity is a prominent exporter of liquor and wine products, has invoiced 1 million INR receivable in the month of May, and spot rate on the date of the transaction is this much, and spot rate on 31st March is this much. Now we need to show the effect of the transaction. So first effect would be the record of transaction, record of sale transaction, right? And second effect would be record of forex gain oblique loss on reporting date. So these are the two transactions or two items which we need to account for. Just try this once, come up with your answer, and then we will discuss. Very easy question. We have done a lot of practicals by now. We are now should be able to crack this easy question comfortably. Okay. I hope you must have, solved this question. So let's see what is the correct answer. Alpha will revalue its INR receivable at the closing rate. So since sales are being made, so first entry would be debtor account debit to sales account. Second entry would be debtor will be reinstated, right? So if this is a profit, then P&L will be credited. If this is loss, then P&L will be debited. Here in this case, there is a loss, revaluation loss. So what we will do, P&L will be debited to debtor, right? So debtor to sales and P&L to debtor. This would be the entry. Now, how much loss? $1,000 is the revaluation loss which will be accounted for in the books. How that has come? 1 million into में 0.018 minus 0.017, right? So how much? 0.001 into में 1 million. 1 million means 10 lakhs, right? So if we multiply this will give us 1,000. So $1,000 is the revaluation loss. That is the delta. Because initially, what entry I would have record? So I would have record debtor account debit to sales. Debtor by how much? 10 million into 0.018. Right? So this was the amount debtor to sales. And now P&L debit by $1,000 to debtor by $1,000. Right? This would be the second entry I would be recording. So this is the accounting impact of this. So question was very easy. It's just a matter of fact, clarity of the concept, how this needs to be done and how the journal entry needs to be passed. Okay. Let's try this one. So all these MCQs are, very important MCQs. If they come up in the exam or, some sort of similar version come up, it would be helpful for you to score good marks if quickly, solve these MCQs. XYZ Limited prepares consolidated financial statements during the financial year ended 31st March 2020. XYZ disposed of an investment in the foreign operation. Okay. Now we have done the studied the concept of the disposal of the foreign operation, right? So now this MCQ is pertaining to that concept. Up to the date of the disposal, XYZ had to translate the financial statement of the foreign operation. Sorry. Of the foreign operation from another currency for inclusion in its consolidated financial statements. During the prior reporting periods, INR 14,000 of the exchange difference gains, net of tax, pre-tax exchange difference gains, INR 20,000 had been recognized. So 14,000 is the exchange gain or loss net of tax, and pre-tax exchange gain or loss is 20,000 given in the question. And it was recognized in OCI in the consolidated financial statements of XYZ Limited. During 2020 reporting date, INR 3,500 exchange difference gain net of the pre-tax exchange difference gain of 5,000. So 3,500 is the net of tax and 5,000 is the gross exchange gain up to the date of the disposal of the foreign operation had been recognized in OCI. Which one of the following statement is correct in relation to the treatment of the disposal of the foreign operation in the consolidated statement of profit and loss and OCI of XYZ Limited for the year ended 31st March 2020? So XYZ Limited is preparing the consolidated financial statement for 2020 March ending. They had disposed an investment, right, for which 14,000 net of gain was recognized for earlier periods and 3,500 was the gain on account of the disposal. Now, which of the following options for giving this accounting impact are correct? Number one, other comprehensive income would include an exchange difference net of tax 3,500. Other comprehensive income would include reclassification adjustment net of tax of INR 14,000. Other comprehensive income would include a reclassification adjustment net of tax of INR 17,500. No reclassification adjustment from OCI to PNL is necessary on the disposal of the foreign operation. So A, B, C, or D. What is the correct answer? Just, try this one. I'm waiting. In the meantime, you are trying. Okay. I hope you must have come up with the answer. So what is the answer? Let's see. The correct answer is option C. What is the option C? Other comprehensive income should include a reclassification adjustment for amount INR 17,500 net of tax, right? Now, when we had discussed the concept of disposal, right? So we have, discussed there that standard requires whatever is the outstanding, accumulated foreign currency reserve that needs to be reclassified from OCI to PNL, right? On disposal or in the year of disposal. So as the foreign operations was sold, that is disposed of during 2020 reporting period, the total exchange gain or loss net of tax over the life of the foreign operations, that is since when this foreign operation was acquired from that date till today, that is the date of disposal, whatever is the accumulated gain or loss appearing in the foreign currency reserve would be included as a reclassification adjustment in the statement of the PNLs. That is, it will be reclassed from OCI to PNL. Now, for that financial year, the total exchange difference gain net of tax to be reclassified from OCI income is INR 17,500. That is 14,000 plus the current year gain. So 14,000 was the old balance plus 3,500 is the current year. So all in all, total amount becomes 17,500 that needs to be done or adjusted through reclassification adjustment from OCI. Correct? So this is what we have discussed when we had discussion around the disposal of interest in the foreign operation. Right? So this is the MCQ around that concept. So if we, understand the concept clearly, then it is very easy to pick up, these MCQs and score good marks in no time, right? So that was it from my side on this standard. I hope I was able to explain all the concepts, in easy and understandable manner, supported by, practical questions and the MCQs around those concepts to help you, with uh, uh, so that you understand the concepts, clearly. So with that note, I wind up this session for India's 21. I hope you will like it, and all the very best for your examination. Thank you. Session is over.
Okay, sir. Thank you.
Thank you.